Property taxes are rising in many parts of the United States. And for working professionals, this shift is becoming a steady driver of higher housing costs. Unlike mortgage rates, which are locked in for many homeowners, property taxes are not fixed. They are reassessed. They adjust with home values, local budgets, school funding needs, and municipal spending pressures. For mid career professionals who purchased homes during lower rate periods, the mortgage portion of their housing payment may feel stable. But the tax portion is not static. It evolves, sometimes gradually, sometimes noticeably. Across suburban counties and metro areas, reassessment cycles have begun reflecting the sharp rise in home prices seen over the past several years. Even in markets where prices have leveled off, prior appreciation is still working its way through assessment formulas. This means homeowners may not see the impact immediately after buying, but several years later. For many American professionals in their 40s and 50s, housing expenses now include mortgage principal and interest, home insurance premiums, property taxes, maintenance and capital repairs, HOA fees in certain communities. When property taxes rise, the effect often shows up in escrow adjustments. Lenders collect property taxes monthly as part of the mortgage payment. When tax bills increase, the monthly housing payment increases as well, even though the mortgage rate has not changed. This is one of the quiet ways housing costs expand. Property tax growth is often linked to local funding structures. Public schools, infrastructure projects, emergency services, and municipal staffing all depend heavily on property tax revenue. In growing communities, rising demand can lead to expanded budgets. In slower growth areas, shrinking tax bases can result in higher rates to compensate. For homeowners, the mechanism may feel distant, but the financial effect is immediate. Midlife professionals are particularly sensitive to this shift because their broader expense structure is already layered. At this stage of life, households may be balancing college savings timelines, healthcare premium increases, retirement contribution acceleration, maintenance cycles on aging homes. Property taxes layer directly into that structure. Unlike voluntary spending categories, property taxes are mandatory. There is no ability to reduce usage or adjust consumption. They are tied to ownership. In some states, homestead exemptions or assessment caps provide partial protection. In others, reassessments reflect closer alignment with market values. The variation across states can be significant. States like Texas, Illinois, and New Jersey are often cited for higher effective property tax rates. But increases are not limited to those states. Many previously moderate tax regions have adjusted rates or assessed values upward following market appreciation. Even homeowners who purchased modestly sized properties can experience upward pressure. An important distinction is that property taxes are based on assessed value, not necessarily current sale value. But those two numbers often converge over time. For professionals who bought homes 5 to 10 years ago, reassessment cycles may now be reflecting the strong housing market of recent years. This creates a delayed housing cost effect. While mortgage payments remain stable under fixed rate loans, the tax portion introduces variability. Over a 10-year period, incremental increases compound. A small annual adjustment can meaningfully reshape total housing cost. This shift is rarely dramatic. It does not arrive with urgency language or financial alarm. It appears on an annual statement, a revised escrow notice, a new county assessment. Yet over time, it changes the cost structure of staying in the same home. For working professionals whose income growth has normalized, rising property taxes can narrow monthly flexibility. Salary increases in mid-career often track inflation rather than exceed it significantly. Meanwhile, fixed housing components, insurance and taxes, can rise at rates above general wage growth in certain years. This mismatch creates subtle compression. Another dimension is school district funding. Homes located in high performing districts often command premium valuations. As those valuations rise, tax assessments may follow. Homeowners benefit from property value appreciation, but the tax obligation tied to that value increases as well. In retirement planning discussions, property taxes are increasingly part of long term housing affordability modeling. Unlike a mortgage that eventually amortizes, property taxes continue indefinitely. Even after a mortgage is paid off, taxes remain a recurring obligation. For professionals planning to age in place, this matters. A paid off home does not mean housing costs disappear. Insurance, maintenance, and property taxes continue. This structural reality is becoming more visible as more households reach late career stages. Municipal budgets are also adjusting to inflation in labor, public services, and infrastructure repair. Roads, utilities, emergency services, these costs rise with inflation. Property taxes often reflect those increases. From a housing cost perspective, property taxes represent a dynamic component influenced by local governance decisions, real estate market trends, community growth patterns, inflation in public sector wages. These drivers are not directly controlled by homeowners. That distance between cause and effect contributes to the sense that housing costs are gradually expanding without a single dramatic trigger. For professionals who purchased homes during stable tax environments, the change can feel new. But historically, property taxes have rarely remained flat for extended periods. The key shift today is the combination of rising insurance premiums and rising property taxes occurring within the same period. Inside the housing cost cluster, these two components now represent the most variable elements of homeownership. Mortgage rates draw attention because they are visible at purchase. Property taxes draw attention later, often years into ownership. For midlife households focused on financial stability, understanding property taxes as an evolving housing expense, not a fixed one, brings clarity. It reframes housing from a static payment to a layered financial structure. This does not imply instability. It reflects structural reality. Housing costs in the United States are composed of multiple moving parts. Property taxes are one of the most consistent long-term variables. And for many working professionals, that variable is now trending upward.